So right now, you have to remember, you have to keep in mind that every time you buy that stock, AMC or APE, you're buying a company that has a net worth of minus 2.6 billion. So as you can see here in this chart, the number of movie tickets sold in the United States and Canada from 2001 to 2022, there is a really big downward trend. I mean, it's very, very obvious that there's a huge downward trend in the demand. Enterprise value is market cap plus total debt minus liquid assets. This gives you the true enterprise value of a company. So let's look right here. The enterprise value in 2017, as you can see here, if we look at that chart right here, they're basically eating up cash pretty quickly. The average quarterly cash usage is about 240 million. Hello, AMC Apes. I hope you're having a great day. Welcome to my channel. And remember, if you're having a terrible day, at least your name is not Fatty. So today I would like to talk to you about AMC on a micro level, as well as the entire movie industry on a macro level. So let's dig in. So as you can see here, I have 2017 all the way through 2023, which, you know, it's missing information. May 5th, I think, is when the first quarter reporting is. So let's discuss the revenues real quick from 2017 to 2022, what happened with AMC. So as you can see, the revenues here were 5.1 billion in 2017. They went up, they ticked up a little bit, 400 million, 500 million, as you can see here. And then of course, you know, we know what happened here. The health crisis we had, it dropped of course to 1 billion. And then it started ticking up again, which is a really good sign. The revenue growth, as you can see, from 2016, 2017 was spectacular. It was almost 60% revenue growth. And then it started dropping in 2018. The growth started dropping. Instead of 60, dropped to 8%. And then terrible 0.18 in 2019. And of course, we know what happened here. EBITDA is basically earnings before interest, taxes, depreciation, amortization. And depreciation, amortization is non-cash items. So it's true cash to the company. So we're looking here at EBITDA, and it went from 500 mil, this is all in millions. It went up to 1 billion, which is great. And then it started dropping again, as you can see here. From 2016-17, it dropped 11%, and then it doubled basically in 2018. It looks like 2018 was a great year, and then the problem is it started dropping. It dropped by 40% in 2019, and of course, like I said, we know what happened here. Total debt, of course, exploded from 8 billion to an all-time high of 13 billion in 2020, and then they started paying down the debt little by little, but it's still really high at 11 or 12 billion basically when you round up. Total P&I is principal interest expense on that total debt, and as you can see here, it was very low in 2017, measly 360 million. And then it started ticking up, of course, because they started borrowing more to fund the losses they had during the health crisis we had. And as you can see here, it's $1 billion in 2021, and pretty much the same, $1 billion almost in 2022. This is just the principal and interest payments on the mortgage, on the debt they have of $12 billion. I did a calculation for debt service coverage, which debt service coverage equals EBITDA, which is this number right here, divided by the principal interest. Basically, you want it to be at least 1-to-1 or 1.0. So for example, if total EBITDA is 100,000, P&I, the principal interest should be 100,000. This is break even. You want it to be at least break even. So like I said here, it was pretty decent. 2017, they killed it in 2018, and then it started dropping. Of course, we know what happened here, but the good news is the number is improving from -4 to -0.25. So they're doing a good job, improving their deficient ratio right here. Hopefully it'll break even soon. We'll see. Net worth is basically total assets minus total debt, is what the value of the company, the net worth of the company is. And as you can see here, it was 2 billion in 2017 and it started dropping. And of course, so right now, you have to remember, you have to keep in mind that every time you buy that stock, AMC or APE, you're buying a company that has a net worth of minus 2.6 billion. It's negative. So you're buying a company with negative net worth, which, like I said, is the total assets minus total debt. So you basically, if you want to calculate your net worth, you calculate all the values of your car, if it's 30,000, 20,000, your house, everything, and subtract total debt. You have mortgages, car loan balances, all the stuff, and this is your net worth. So the net worth here is minus 2.6 billion. I just want to point this out. The total debt, the debt to tangible net worth. So basically, this is the total debt, right? This number right here, divided by the total net worth. And you want it to be low. Basically, the lower the better, because the higher the ratio, the higher the debt. And that's not good. You want the net worth to be higher than the debt. So here, it was kind of high, 5.7. It's usually like, we like to see 3 times. It's pretty decent. But here it blew up to 10 times. And of course here it's negative again because of the terrible, they just kept, reporting losses and whatnot and higher debt. So of course it makes sense. And the net worth is, remains negative. It's actually got worse in 2022 because of higher debt. But let's move on. Cash reserves, it was 310 million and it blew up to 1.6 billion. I'm thinking that's because of all the substantial stock purchases and they sold shares, and of course their cash reserves blew up. And I think end of 2022 was 632 million. And as you can see here, if we look at that chart right here, they're basically eating up cash pretty quickly. The average quarterly cash usage is about 240 million. So I'm thinking they probably have about 2 more quarters and they're completely out of cash unless they raise, they sell more shares. But the problem with that is the earnings per share is already negative. If they sell more shares, that number is going to get worse. And of course, that number is going to get way worse. So you're darned if you do and darned if you don't, because they're going to run out of cash in literally 2 quarters, it looks like, and maybe 2 or 3 quarters. But when they raise more when they sell more shares, is going to kill the earnings per share. So every time you buy that stock, APE or AMC, is going to be pretty much worth less than 0, the earnings per share and the price to earnings. So it's not looking very good. I just want to point this out to you. It's up to you to buy it or sell it or short it or whatever. I'm just pointing the facts. So let's move on to market cap. And market cap is stock price times total number of outstanding company shares. And if you look at the market cap, I'm going to show you this again so you'll know what it is. But it's 1.8 billion in 2017. It dropped a little bit in 2018, and then it started dropping more and more. And of course, here in 2021, it just blew up to 26 billion because the stock price just absolutely skyrocketed. I think it was $80 or something like that. So that's why it was 26 billion, which is outrageous right here. The average market cap is about 1.1 billion, to give you an idea. As of 2022, it was 4.6 billion, which is 5 times more than the normal, almost 5 times more. In 2023, which is right now, it's 2.7 billion. So it's still a good 2-3 times almost the average. One reason I think why the market cap is way out of whack with historical figures, because as you can see here, back when the market cap was about 2 billion, the revenues were 5 billion. And then again, when it was 1.5 billion, the revenues were 5.4. So as you can see, the revenues now are 3.9 billion. It doesn't make any sense for the market cap to be almost 5 billion, almost 5 times what it was when revenues were above 5 billion. So just keep in mind that right now the market cap for AMC is around 3 billion or so in 2023. However, historically speaking, when the market cap was around 1.8 billion and 1.5 billion or so in 2017 and 2018, the revenues were way above 5 billion. Right now, the revenues are only 3.9 billion, or as of 2022, are 3.9 billion for AMC. However, the market cap was 4.6 billion in 2022, and right now it's 3 billion or more market cap for AMC. So just keep that in mind moving forward. So let's move on to enterprise value of AMC. So to explain to you what enterprise value means, here's an example. When you're buying a house, it's worth, let's say, $300,000, and you put a down payment of 20%. That's $60,000. That's your equity. And then you go out and get a mortgage for $240,000. The enterprise, quote unquote, enterprise value of your home is the down payment of $60,000 plus the mortgage of $240,000. That equals $300,000. So in that example, the enterprise value of your home is $300,000. Enterprise value is market cap plus total debt minus liquid assets. This gives you the true enterprise value of a company. So let's look right here. The enterprise value in 2017 was 9.2 billion. It stayed stable, and then it blew up to 13 billion again in 2020, and then in 2021, just absolutely insane, 40 billion, 4 times the average. Then this is the average is 10.5, so it literally became 4 times because it just blew up out of, just outrageous numbers, the stock price. And as of 2022, it was 15.7 billion, which is really, really high still compared to the average. The enterprise value to EBITDA, as you can see here, which basically tells you the number of years it will take to pay off the initial value you invested in the company. So, which makes sense, like you divide the enterprise value divided by the EBITDA, which gives you the number of years. So 19 years in 2017 to pay off, that enterprise value using the EBITDA numbers. And then 10 years, 22 years. And of course, it's an absolute disaster because they have negative EBITDA, like 4 billion negative. And here is getting better, like I said, 235 million. So now let's look at the net debt to EBITDA value ratio. You want the number to be maximum 3 years. And this is the number of years it takes to pay down debt using EBITDA, which is kind of the same idea, but using debt just to kind of see what the health of the company is. So 16 years in 2017, 8 years, 21 years, or 22 years, rounding up, and then it becomes a disaster again. It's getting worse, actually. Because why? Because the debt is getting way, way high compared to the average. So this is the micro level I just discussed for AMC as a company, the internal numbers, what they look like. Now let's discuss the macro level. So guys, let's talk about what the expectations are for this stock. If you are hoping for the stock to hit $80 anytime soon again, I got some bad news for you, because back when it hit, if you just do the quick math, back when it hit $80, Margin borrowing, which is what you, like if you have cash of 100,000, 10,000 in your brokerage account, you can borrow using that cash. I think it's 2.5 times. So back in the day in 2021 or whenever the stock hit $80, margin borrowing was next to zero. It was like 1.1 or something, very cheap borrowing. That's why the stock hit $80, because everybody, they basically leveraged their money to have more power to borrow. That's why the stock hit $80. That's not going to happen anytime soon, because right now the margin, last time I checked, the margin interest was 8-9% or more. I'm not sure. This is never going to happen again unless the Fed starts cutting, and the margin, which is going to take a while for the margin borrowing, interest borrowing, to go down where it was before, which might take a long time. So if you're banking that it will hit $80, $50, $40, whatever it is, not counting the reverse split, you're going to be very disappointed. So I just wanted to point this out to you. Now let's discuss the macro level analysis of the entire movie industry. As you can see here, this is the total sales, ticket sales for Europe and the US, since AMC has 2,800 screens and 353 theaters in Europe, 7,755 screens in the US, and 593 theaters domestically. So I did a quick kind of number crunching to see what the US and Europe sales were for 2017, 18, 19, all the way to 2022. And as you can see here, it was 15.9 billion. And then it went up to 18, which is great, 18.6, 18.4. And then it started dropping. Of course, we know why. So now it's back at 13 billion, which is great news. However, let me show you a chart that shows you the total number of ticket sales versus the total gross sales of movies. So as you can see here in this chart, the number of movie tickets sold in the United States and Canada from 2001 to 2022, there is a really big downward trend. I mean, it's very, very obvious that there's a huge downward trend in the demand. And this, like I wrote this myself in the chart, the core demand for movie tickets plummeting. It's literally plummeting from 2002 all the way to 20. That's not good, because if the core demand is dropping, if you have a hot dog stand, and you keep raising your prices for a hot dog instead of $1, because you can see the demand going down, you keep raising the price of a hot dog instead of $1 to $1.50, but the number of people coming to your shop or your food truck is dropping from 100 a month to 90 a month to 80 a month, but you keep raising prices to keep your revenues the same, the sales the same. Do you see what I'm saying? So basically the number of tickets sold is plummeting. Why? I'm thinking because of platforms like Peacock and Netflix and Hulu. I mean, I have an experience with this. There was a movie called Megan, the little robot child that came out, and I really wanted to see it at the theater, and I was planning to go see it on a weekend, and I saw the reviews were great and everything, and I have Peacock, and I opened the app Peacock on my TV, and all of a sudden it popped up, hey, Megan, the movie, free, and I paid $4.99 a month for Peacock. It popped up, and guess what? I watched it. It wasn't that great. It was okay. So I didn't spend $20. I spent $4.99 a month. So I think that's why the demand for going to the actual, physically going to the movies is dropping, because of platforms like Netflix and Amazon Prime and all that. So just pointing it out to you. Okay, let's get back to the charts. I have another chart actually right here. It shows you what I'm talking about. So the number of ticket sales declining versus the total gross sales rising due to higher costs. So pretty much, as you can see here, the blue line is the actual number, the demand, the tickets sold. This is before before the health crisis we had, you can see there's definitely an obvious trend, a pretty big trend dropping here from 2001, 2003 all the way here. And then, however, you can see the revenues, the actual box office going up. That's because the actual ticket prices are going up. However, if you think about it, like the example with the hot dog stands, you know, that owner of the hot dog stand keeps raising prices. I mean, people will eventually stop going, right? Will eventually stop buying hot dogs from this guy because he keeps raising prices to keep, you know, to keep his sales even though the demand is plummeting. So this is very, very big risk. Just think about that every time you buy APE or AMC. Just think about the demand for movies is plummeting based on the ticket sales. So they can only raise so much until people start realizing, you know what, like the Megan example, I'll just watch it at home on Netflix or whatever. So just keep that in mind. All right, guys. I just wanted to give you the information that I did my analysis on, and it's up to you to buy it, sell it, short it, whatever. But in conclusion, I think it's very risky to buy a company that the actual demand for its products or services is declining. As you saw in the charts, the demand for this product is declining. So that's pretty scary to me. You know, like I said, it's up to you what you want to do, but I think I would rather buy something where the growth is exploding, like AI or any kind of technology stocks, any of that stuff. But, you know, a company that has very obvious declining trends in the core business operations, that's pretty scary to me. So anyways, thank you so much for watching. Please subscribe. It took me a long time to get all this information together for you, and I'll have a bunch of new videos coming out, other stocks, popular stocks. So just tune in and make sure to click the notification bell. Thank you so much.